Welcome to Skill Maker 101. This is a space for learning and growth. We're dedicated to delivering the best educational contents and help you gain knowledge and sharpen your skills in a unique and engaging way, without ever compromising our core belief: better skills, better you. In our previous Beginner's Basics number 2, we discussed that for every option contract to exist, there must be both a seller and a buyer. If you haven't watched that video yet, I highly recommend checking it out first. It lays the foundation for what we're covering today. Disclaimer: all kind of investments carry risks, and options investing has got no exception. This video is solely for education purposes and shall not in any way constitute any stocks or options investing recommendations. Investors should exercise own due diligence before executing any trade. In this video, we'll walk you through the put option step by step, from both the seller's and buyer's perspective, at the same time. This way, you'll get the full picture, which is crucial for understanding how options trading actually works. Let's begin today's learning with a quick recap of what a put option is and its basic characteristics. Sell put, as the put seller. You don't need to own 100 shares. But you must have enough cash to buy 100 shares if the put buyer exercises his right to sell or assign 100 shares to you. If you don't own the shares, this is called selling a naked put, which is dangerous and you will be exposed to margin call or liquidation risks, and should be avoided. You receive a premium upfront. Typically, your goal is waiting to buy the stock at a lower than the current market price. In short, a put seller is usually bullish or neutral on the particular stock, expecting the stock will stay the same or go up. This way he will win the trade, as the put buyer will not exercise his right to sell 100 shares to him, and the put option simply expires worthless. On the other hand, by put, as the buyer, you own 100 shares that you want to protect against sharp price drop. You don't need cash to buy more shares, only enough cash to buy the put option. If you don't own the shares, this is called buying a naked put, which is dangerous as you are exposed to margin call or liquidation risks, and should be avoided. You pay a premium upfront. Typically, your goal is waiting to sell shares at higher than market price if the price drops significantly. In short, a put buyer is bearish or cautious on a particular stock that he owns, expecting the stock price may drop significantly and want protection. This way he can reduce his loss by exercising his right to sell 100 shares to the put seller if the stock price drops significantly. Now, let's look at a simple story to help you understand how both the put seller, sell put, and the put buyer, buy put, enter a trade, and what each of them is thinking. Mr. A is an option trader who believes ABC is a good stock to own, but he feels $200 is a bit too expensive. He thinks $180 is a fair price he'd be happy to buy it at. So instead of buying the stock now, he decides to sell a put option with a strike price of $180 that expires in 1 month. By selling this put, he collects a $300 premium upfront. Here's Mr. A's plan. If the stock stays above $180, the put option will expire worthless, and he keeps the $300 premium as profit. If the stock drops to $170, he will be assigned and must buy 100 shares at $180, which he's comfortable with. Plus, he still keeps the $300, which lowers his effective purchase price to $177 per share. So, Mr. A is happy either way. He gets the stock at a discount or keeps the premium as income. Now, let's meet Mr. B, another option trader. He already owns 100 shares of ABC. He recently heard that ABC is negotiating a major project that could be a game changer. If the deal is successful, the stock might skyrocket, but if it fails, the stock could plummet. Mr. B is optimistic the deal will get through, and he can reap huge profit. However, he is also cautious and worried if the deal fails. So, while waiting for the outcome, Mr. B wants to protect his shares in case the deal fails. So, he buys a put option as a form of insurance. If the stock crashes, his put option will gain value, helping him limit his losses. And if the stock shoots up, he still enjoys the full upside on his 100 shares, minus the cost of the put premium. In short, Mr. A is using sell put as a way to potentially buy the stock cheaper or earn income, while Mr. B is using buy put as a protective hedge for his shares, like buying insurance. In this example, we can see how unique and powerful a put option is, in helping or resolving problem for both the seller and the buyer. Now, let's look at this simple chart to help you understand the story better. The current market price of ABC is $200, and the put seller and put buyer agree to trade at the strike price of $180. In this example, the put seller, Mr. A, wins in 3 out of 4 scenarios. 1. If the stock goes up to $250. 2. If it stays flat around $202. 3. Or even if it drops slightly to $185. In all these cases, the stock price is still above the strike price of $180, so the put buyer, Mr. B, has no reason to exercise his right to sell 100 shares to Mr. A. As a result, Mr. A gets to keep the premium as profit, and doesn't need to buy any shares. The only time the put seller loses is when the stock drops below the strike price of $180, like falling to $170. In that case, Mr. A is obligated to buy 100 shares from Mr. B at $180, even though the market price is lower. On the other hand, the put buyer, Mr. B, only wins in 1 out of 4 scenarios, that is when the stock drops significantly to $170, which is below the strike price of $180. That's when his put option gains value and he can exercise his right to sell the shares at a higher price of $180. But that's okay for Mr. B, because his goal is protection, not profit. He buys the put mainly as insurance to protect his share value in case the stock crashes. Let's recap what we have learned today. Put seller and put buyer have different goals and views. Put seller, Mr. A thinks stock price will stay flat or go up. He wants income and buys stock at cheaper price. So, Mr. A decides to sell a put to collect premium. However, the put buyer, Mr. B, wants to keep his 100 shares for higher profit in future, but is worried price may drop sharply in the short term. So, Mr. B decides to buy a put to protect his share price if it really drops significantly. Mr. A will have high win rate, he wins in 3 out of 4 scenarios, 75%. Mr. B is okay with low win rate, only wins in 1 out of 4 scenarios, 25%. Because his goal is win big in future when stock price shoots up. So, he's okay to pay some premium as protection now. In my next video, we will explore the call option, and explain the difference between the sell call and buy call step by step from both the seller's and buyer's perspective. If you found this video helpful, don't forget to like, subscribe, turn on the notification bell and share with your friends as well. Thanks for watching, happy learning, and I'll see you in the next video. Bye.